Good morning and welcome to The Street here on BNN Bloomberg. I'm Paul Bagnell. Thank you so much, as always, for joining us. Our featured guest of the morning is Bala, CEO and Senior Portfolio Manager at AIP Investment Management. He'll tell us why he thinks Canada's federal election could be a generational event for investors in this country. In the meantime, let's get started with some stories that we're watching for you here in the newsroom. There is a look at the U.S. futures market. As you can see, the contracts are up fairly significantly so far this morning. There's a comment from Donald Trump that we'll tell you in just a moment, which is driving those markets. In fact, we'll tell you about it right now. There's a look at the futures markets after big gains of yesterday. Those contracts are higher today, mainly because of a remark made yesterday by U.S. President Donald Trump. Trump said he has no intention of firing Jerome Powell, chair of the U.S. Federal Reserve Board. That comment, of course, came just one day after Trump called Powell a, quote, major loser and said that Powell's departure from the Fed could not come fast enough. It's just another example of how volatile and news-driven markets are these days. Let's talk about the state of markets with our featured guest of the morning, with Bala. He's Chief Executive Officer and Senior Portfolio Manager at AIP Asset Management. Jay, thanks a lot for coming in.
Hey, thanks for inviting me.
These are very fragile markets, obviously. There's lots of headlines that skew the markets. This Trump comment is the one that seems to be driving sentiment this morning. It'll drive sentiment until it stops driving sentiment. But the story in the background is really trade tensions, and the markets worry about where the world economy, where the U.S. economy is going on trade.
Right. And so if you look at it today, I mean, look, we're one tweet away from a 1,000-point move in the other direction. And that's the markets we're living in today, right? So today, we had obviously two great pieces of news. One was not firing Jerome Powell. You're not supposed to fire Jerome Powell to begin with, right? And the second one is, tariffs might not be as harsh on China. But again, they're astronomical now. They're at levels where you pretty much can't trade with China.
Exactly.
And they're going to come back to maybe some normalized level. But again, we don't know, right? The only certainty that we know is that the next 4 years is going to look a lot like the last few months, right? And so, what we always tell our investors and, what we always speak to people about is, these are great times to sort of strategically rethink your portfolio, right? Better to go back to first principles, right? Just look at the world for the next 4 years and say, look, this is the way it's going to look, right? How do I want my portfolio to look, right? And so the last couple of days has been nice in that you've had that rebound in the equity markets. So, you have the ability to take some profits off the table, right? And so when we say, go back to first principles, the first principles is go look at your portfolio and say, okay, am I truly diversified, right? That's number one. Mm-hmm. And do you have exposure to your three basic asset classes, right? Equities, fixed income, alternatives. And once you've made that choice, okay, you've got those three covered, you want to make a decision on, okay, well, which ones do you want to manage on your own? And which ones do you want to outsource, right? Is there certain asset classes you're just not comfortable with, you don't have an understanding of, or you just don't enjoy doing, right? And so we know investors that love the equities, love trading the stock, hate the bonds, yep. Don't want to go through the brain damage of trying to figure out what alternative investments look like in their portfolio, mm-hmm. And so they outsource that component, to us, to financial advisors, to PMs we know. So, I think it's a great time, honestly, to make those decisions, right? To spend that time to say, look, we've got some luck here. We've got some good tweets that have moved the market in the right direction. This is your best time to take some profits off the table from your equity table and start thinking about, okay, let's reposition, let me rethink, and let me figure out, where my next steps are. Let's
talk a bit more about alternatives. Tell us how you define them. And I think I get the impression many investors don't have alternatives in their portfolios. They've got most commonly a 60-40 portfolio, perhaps, or maybe a 70-30 portfolio, exactly. Equities and bonds, and they don't have anything in alternatives. Talk to us a bit more about alternatives.
Sure. Again, when we think about those asset classes, those have changed, right? So, today the new models are closer to, a 40-30-30 model, or it's more of a 50-30-20 is the models we're seeing today. And the key reason for that is if you look at the amount of carnage in both the equities and the fixed income markets, the alt market has pretty much avoided a lot of that volatility, right? So, they've become volatility dampeners. And so when we talk about alternatives, it's a broad category. So we're talking about hedge funds, we're talking about private credit, we're talking about private equity, we're talking about pre-IPO stocks. And all of these asset classes have become so big that they deserve a good look, right? So, the pre-IPO market alone today is 1,200 unicorns. Each of these companies are well worth north of $1 billion, and in totality, they're worth about $3 trillion.
How do retail investors get access to the pre-IPO market?
That's a great question. So, obviously through companies like us, right? But, that again comes back to that idea of, do you want to outsource a certain sleeve of your portfolio, right? Do you want to say, look, I don't know this world, and it's a different world, right? Like it's less transparency, it's a lot of relationships. You need to know people, you need to know how to structure them, how to go through the due diligence.
How liquid is that market?
It depends on the stock. So, if you look at your top 10 stocks, like, OpenAI, which we own, right? It's relatively liquid. You can actually move that around, as you go down the scale.
And when you use the word stocks, but these are pre-IPO securities, are they? These are privately traded stocks, are they?
Correct. So they're privately traded stocks. So, they custody differently. So you can't just go put it in your bank. They won't accept it, right? The legalities around buying and selling them are different. You need your own legal counsel. So there's a process that it goes through, right? And it's kind of the same thing with private credit, right? It's like bonds, but it's not bonds, right? It's private loans to companies, and in many cases, it's private loans to public companies. So it's a different skill set that you need to be in that space. And that's why we always say, think about outsourcing the components you don't like, and think about, enjoying and sort of investing in what you do like, right? So that's traditionally been stocks. I think, people should stick to that. It's just they may want to think about, moving some of that off.
Okay, we're almost out of time in this conversation, but I don't want to end this conversation without your thoughts on bonds. One of the big features of this market rout we've seen recently is that bonds are selling off at the same time as stocks are selling off. What's the takeaway there for investors?
Yeah, and so that's once again why we're recommending that people look at private credit as an alternative. So the reality is, ever since 2022, the bonds and the equity markets have moved in tandem. And they moved in tandem 80% of the time. So this is the time where we talk about, again, come back to first principles. Are you truly diversified, right? If all your asset classes move in the same direction, you're not diversified, right?
That's Jay Bala. He's our featured guest of the morning. He's also CEO and Senior Portfolio Manager at AIP Asset Management. Up next, Jay Bala, our featured guest on what investors should be watching for in Canada's federal election campaign. Welcome back. It's time now for On the Radar. That's a close look at what a money manager is watching in the markets these days. We're back with Jay Bala. He's with AIP Asset Management. Jay, you are looking closely, as many investors are, at the current federal election campaign. We're less than a week away from voting day, and you say this has the potential to be a generational event for Canadian investors. One big development in the campaign is that certainly looks like the higher capital gains taxes are something that will not materialize. All parties, or the two main parties, the Liberals and the Conservatives, vowing not to proceed with that plan.
Right. And so, look, capital gains tax, of course, stops money from coming into the country, which is what you don't want. And, at the end of the day, capital gains tax basically blocks risk capital from coming to the country, which is basically the worst thing you can do, right? And so, I think, both parties have taken a position on that. Both have decided, at least the Conservatives have gone as far as saying it's zero capital gains tax, but it's limited to a year, and then they might extend.
Right.
Whereas the Liberals are saying, they're going to roll it back to where it was. So I think that's a great starting point. I did look at the budgets for both parties.
Right, the costed platforms.
Yeah,
right.
yeah. And, honestly, I was really hoping for more. You know what I mean? So, our thesis has always been a very simple one in that, look, Canada should rank, top 5 countries in the world just about at everything because of who we are, our education level, the size of the country, what we have, right? Like, we should. And so if you looked at the past, 10 years or 5 years or whatever you want to look at, if somebody wanted to build a new chip plant, somebody wanted to open up a new business, somebody wanted to move their headquarters, Canada would have not registered in the top 5. We wouldn't even be in the top 10.
Yeah.
And so with all of these new plans, I thought, we would have the common sense to move ourselves up.
What about corporate taxes? There are some pretty prominent voices who say they're disappointed that we're not seeing from either party a plan to significantly move corporate taxes down. Our corporate tax rates are now higher than they are in the United States. We've also got the tariff situation, which is basically another tax on Canadian companies who ship their products to the United States. The Liberal platform, I understand this was referenced by Don Drummond yesterday. I spoke to Don Drummond, the former chief economist at TD Bank, and he's had other very prominent roles as well. He says the Liberal platform includes a pledge to look at corporate taxes, but nothing much beyond that. Do you view it as an imperative that we get our corporate taxes more competitive with the U.S.?
Oh, 100%. Because if we're on par, if our taxes are the same as the U.S., the natural sentiment is you'd rather open the business in the U.S. They're 10 times the size, and so the market's easier, right? So we have to be competitive. Like, we can't just match. We got to beat by a significant margin for somebody to come here and say, okay, that makes sense, right? And so, the country I always point to as, sort of rock stars in this business is, Ireland and Switzerland, right? Like, they're smaller countries, but, if you think about, would they be in the top 5 for somebody looking to park a lot of money or to build a new plant or set up a headquarters? They'd rank there. So the question is, why can't we rank there, right? Like, we've already got the precedents. And so it's really just copying models, right? We're just going to look at those two countries and say, okay, what could fit in the Canadian context?
And do you know, have those countries experienced a significant increase in corporate tax revenue because of the lower tax rates? If you're going to sell this to Canadians, you need to explain that corporate tax rates may come down. But if there's more activity, revenue from companies operating in the country will rise in the aggregate.
Yeah, and so the way you want to really think about it is, I think the one you want to really look at is, has personal incomes gone up, right? Like, as the average person in those countries, are they doing far better than we are? The answer is absolutely, right? I think Ireland pretty much doubles us in terms of GDP per capita, right? And so, the answer to taxes is, a tax is a tax is a tax. It doesn't matter how you collect it. At the end of the day, it's a percentage of GDP you're going to collect. And whether you take that from companies, whether you take that through tariffs, or whether you take it through sales tax, it's irrelevant, right? So countries need to just make a decision on that and have a mature discussion with their taxpayers to say, look, this is how much we're taking. That's what we need to run the country. Yeah. And we need to come to terms with that, right? And I think, I think countries like Switzerland have done a good job, and Ireland have done a good job just explaining and saying, look, this is the way it works, right? We camouflage it all, right? We say it's corporate, it's this, it's that. But at the end of the day, we end up paying far more than most countries, right?
Let's circle back to something we talked about earlier in our earlier conversation. Are there implications for the IPO market in Canada in the federal election campaign? Policies that a new federal government could enact to spur more companies getting to the finish line on IPOs?
Yeah, I mean, at the end of the day, it's got to come back down to, can we have an influx of money coming into the country, right? So the less barriers we put into that, the more likely you're going to have a healthier IPO market, right? If I say, look, you could invest in a pre-IPO company, if the stock goes up, we'll tax you at 90%. Would anybody bother investing? The answer is no, right? So obviously, capital gains tax at 0 is going to drive more capital into pre-IPO companies. It's going to allow them to grow and expand and increase their revenues and then be healthy enough to come into the public markets, right?
Jay, thanks a lot for being here today. We appreciate it.
Absolutely. Thank you for having me.
That's Jay Bala. He's Chief Executive Officer and Portfolio Manager at AIP Asset Management. Still ahead, we'll bring you today's latest headlines. We'll take an updated look at the markets, and then we'll go over Tesla's latest results.